$200 a barrel. That's the number Donald Trump put on television on April 21, 2026, and most of the room laughed it off. Citi published a note 4 days later, JP Morgan another one, Goldman Sachs raised its forecast the day after. 3 banks, 3 rooms, the same conclusion. If the Strait of Hormuz stays closed past mid-May, Brent crude prints somewhere between 150 and 200, and the world starts paying for it at the pump within 72 hours. But here's the part the headlines skipped. While Brent in Rotterdam was already trading at $142 on April 27, West Texas Intermediate in Cushing, Oklahoma was sitting at $87. Same product, same week. A $55 gap that has never existed in the modern history of oil markets. By the end of the trading day on April 28, that spread hit $25 on the front-month contracts alone, and it's still widening. So the question is not whether $200 oil is coming. The World Bank issued the warning this morning, largest energy price surge since 2022. The question is why your gas pump in Houston still reads $3.40 a gallon, while a delivery driver in Lyon is paying the equivalent of $9.20. Why a Permian roughneck just got a raise, while a German chemical plant is shutting down its 3rd furnace, are about to live 2 completely different decades. The answer is a wall that was not built last week. It was poured slab by slab over 12 years, and you were not supposed to notice. We're going to walk through how it was built, who built it, and what happens when the math finally catches up to it. Because there's a catch in this fortress, a line where the numbers stop working, and we are heading straight for it. On March 4, 2026 at 0642 GMT, the Iranian Revolutionary Guard Corps announced the closure of the Strait of Hormuz to all commercial tanker traffic. Within 19 minutes, Brent crude jumped $14 on the ICE Futures Exchange in London. Within 2 hours, 12 VLCCs that had been transiting toward the Persian Gulf turned around in unison, like a flock of birds reading the same wind. 21 million barrels a day, roughly 20% of the world's seaborne oil, stopped moving. That's the moment the map tore in half. In the 7 weeks that followed, a strange thing happened to oil prices. Brent, the global benchmark priced in Rotterdam, refined for Europe, Asia, and most of Africa, went vertical. From $78 on March 3 to $124 by March 27 to $142 on April 27. A 76% climb in less than 2 months. Goldman Sachs called it extreme inventory draws. Kepler called it structural fragmentation. Citi gave it 3 scenarios, and the worst one prints 150 by July. Then there's the other curve. WTI, the North American benchmark priced in landlocked Cushing, barely flinched. It moved from 71 to 87, a $16 climb, the same global crisis. The same headlines, the same Iranian missiles flying over the same shipping lanes, and yet WTI behaved like a different commodity entirely. For a few days, traders in Houston thought it was a settlement glitch. It wasn't. By March 19, the White House confirmed it was not planning to ban oil exports. Bloomberg published the statement at 11:14 a.m. Eastern, and the spread didn't close. By April 16, BNN Bloomberg ran a headline that should have been a national event. The United States was within 10 days of becoming a net crude exporter for the first time since the Second World War. Nobody clapped. Nobody marched. The Permian just kept pumping at 6.4 million barrels a day, the EIA confirming on April 14 that U.S. production was sitting at a 2025 record level, and that the Permian alone now accounts for roughly half of all American crude. Now stop and think about that sentence for a second. While Tehran was firing rockets at refining infrastructure in Saudi Arabia, and Asian refiners were taking diesel runs offline because the math had stopped working, one single American shale basin, a strip of dust between Midland and Hobbs, was producing more barrels per day than the entire continent of Africa, and it had no reason to slow down. So the question stops being, what's the price of oil, and becomes something else entirely. It becomes, which oil? Whose oil? priced where? Because by mid-April, the world had two oil markets running in parallel, and only one of them was on fire. This is not what 2008 looked like. It is not what 1973 looked like. In every previous oil shock, North America imported the pain along with the barrels. Drivers in Dallas paid the same fundamental price as drivers in Dusseldorf, give or take logistics. The shock was global because the network was global. But in 2026, something inside that network had quietly fused shut. A trapdoor closed, a boundary hardened, and from one side of it, the chaos looked like CNBC noise. From the other side, it looked like a tsunami. There's one more detail to hold on to before we go further. Trump made one phone call on March 11 that you probably didn't notice. We'll come back to it. Because the strangest part of all of this is not that prices diverged, it's that someone in Washington knew exactly how this would play out and let it happen. Permian, remember the name, because in the next 4 minutes you'll see it bend the entire global economy. To understand why Houston gasoline costs less than half of what a Frankfurt taxi driver is paying, you have to back up to 2012. That's the year US crude production crossed back above 7 million barrels a day for the first time since the Carter administration. It's also the year a small group of geologists at Pioneer Natural Resources started saying out loud what they had been writing in private memos for 2 years. The Wolfcamp Formation in West Texas contained more recoverable oil than Ghawar in Saudi Arabia. Nobody outside the industry believed them. By 2024, they were proven right. By 2026, they were proven right twice over. The EIA refined its estimates again in February. The Permian Basin alone now sits on roughly 75 billion barrels of recoverable tight oil. That is more than every drop the United Kingdom has ever pulled out of the North Sea, ever in its entire history. And the break-even cost, what it actually takes to drill, frack, and ship 1 barrel out of West Texas, is hovering around $38. Below 60, the Permian is profitable. Below 40, it's still profitable for the best operators. So when Brent runs to 142, the Permian doesn't slow down, it accelerates. That's the first slab of the wall, geology. A continent-sized supply of cheap, light, fungible crude sitting under American soil, locked behind decades of capex. The second slab is a treaty almost nobody outside Calgary or Mexico City reads. It's called the USMCA, the trade pact Trump signed in 2018 to replace NAFTA, and buried inside its energy provisions is a quiet revolution. Canadian heavy crude can flow into the United States duty-free in unlimited volumes. Mexican Mayan crude can do the same. American refineries on the Gulf Coast, the most sophisticated downstream complex on the planet, were rebuilt between 2014 and 2022 to digest exactly that mix. Heavy Canadian dilbit at the bottom of the barrel, light Permian at the top, blended in proportions that maximize diesel and jet fuel yields. The result is brutal. In April 2026, the 3-2-1 crack spread on the Gulf Coast, the margin a refinery makes turning crude into product, sat at roughly $38 per barrel, according to RBN Energy. In Northwest Europe, the same spread had collapsed into negative territory by late March because European refineries were built for a light crude grade that suddenly wasn't shipping anymore. Asian refiners, hit harder still, started cutting runs in April. Hydrocarbon processing reported diesel and jet fuel supply at risk across India, South Korea, and Taiwan. So while the world was screaming about oil, the Gulf Coast was running flat out. American refineries hit utilization rates above 96%, a level last seen briefly in 2019. Tankers loaded with finished gasoline, diesel, and jet fuel started leaving Houston, Beaumont, Corpus Christi at a pace that BOE report called boost mode. And every barrel that left did so at the global price, Brent linked, because that's what the buyer in Singapore or Rotterdam pays. Now do the math. American refineries buy WTI at 87. They sell finished product priced off Brent at 142. Their margin doesn't just hold, it explodes. And the dollars made on that arbitrage flow back into the US economy, into wages, into Texas tax revenue, into pipeline capex, into political donations, into a feedback loop that doesn't want this divergence to end. That's the second slab of the wall, refining geometry. The third slab is the pipelines. By June 2024, the Trans Mountain expansion finally went online. 590,000 barrels a day of Canadian heavy crude routed to the Pacific coast at Burnaby, British Columbia. In December 2025, the Oil Sands magazine Pipeline Egress Outlook flagged what almost no European editor noticed. Alberta now has more takeaway capacity than it has production. The pipes are not the bottleneck anymore. The basin is the constraint, which means North America's heavy light blend can be delivered in any volume to the right refinery at the right time every single week of the year. While Saudi Arabia was losing what's been called its swing producer crown, the Middle East Insider published the calculation on April 22, OPEC plus spare capacity dropping below the strategic 5 million barrel buffer. Canada and the United States were quietly assembling something that looks an awful lot like a private oil cartel that doesn't need OPEC to function. And here's the call you missed. On March 11, Trump released 172 million barrels from the Strategic Petroleum Reserve, not to crash global prices, which it didn't, but to give domestic refineries a 90-day inventory cushion at WTI pricing. 3 weeks later, on April 24, his administration extended the Jones Act waiver by another 90 days, allowing foreign-flagged tankers to move oil between U.S. ports. Al Jazeera covered it. Almost nobody else did. 2 moves, same direction. Both designed to keep American gasoline cheap while the world's gasoline burns. The Bloomberg headline from March 19, "White House rules out oil export ban," was the missing piece. Inside the energy industry, that decision was a relief. Inside the trading desks of Goldman, Citi, and JP Morgan, it was the green light. The US would not protect its consumers by hoarding. It would protect them by producing more, refining more, exporting more, and pricing the gap on the way out at whatever the world was willing to pay. This is the fortress. 3 slabs, Permian geology, USMCA refining, pipeline egress, and one political doctrine sitting on top of all 3. Never close the export valve, never break the arbitrage, never apologize for the divergence. The fortress doesn't lower the price of oil, it splits it into the price you pay if you live inside the wall and the price you pay if you don't. But there's a catch in this fortress, a line where the math stops working. We're about to hit it. Let's make this concrete. Pick a name. Klaus, 53, plant manager at a mid-sized German chemicals company outside Mannheim. In January, his diesel cost for the trucking fleet ran €1.63 per liter. By the 3rd week of April, his accountant sent him a contract renewal at $2.41. That's a 48% jump on the single largest variable cost on his P&L. He called the head office on April 22. By April 26, the company announced 2 furnace shutdowns in Q3, 41 jobs. The Euronews piece this morning called it the largest energy price surge since 2022. For Klaus, the surge already arrived. Now pick another name. Raj, 41, runs a regional refinery in Gujarat. He used to import light Saudi grade through Hormuz. Since March 8th, he hasn't received a single confirmed cargo. In early April, he started cutting runs. Hydrocarbon Processing reported on April 14 that Asian refining cuts now extend across India, South Korea, and Japan. Raj's plant is operating at 67% utilization. The diesel he's not making is being made instead in Beaumont, Texas, and shipped to Singapore at Brent-linked prices. His margin is being eaten by a refiner he will never meet, sitting on a different continent, drinking a different coffee. That is what fragmentation actually looks like at the operator level. Pick a third name. Hannah, 29, asset manager at a Dutch pension fund in Utrecht. Her energy book was hedged at $78 Brent through 2027 using paper derivatives sold by a major investment bank. On March 30, the bank called her risk officer and asked for an additional €280 million in margin. The trade is now underwater by an amount that, if Brent prints 180 by August, will eat roughly 4% of the fund's annual returns. She didn't make a mistake. She built a hedge for a world where Brent and WTI moved together. That world ended 7 weeks ago. This is the bill. It is not abstract. It lands on individual desks, in individual currencies, in individual quarters. And it lands almost entirely outside North America. The Energy Intelligence Brief from April called it the fragmentation premium, a regional surcharge that European, Indian, and East Asian buyers now have to pay simply to access oil that, until March, traded at the same global price. Right now, that premium is about $55 a barrel. If Hormuz stays closed through mid-May, JP Morgan's published target says the premium widens. If OPEC Plus can't bring the additional 5 million barrels a day of spare capacity online, and the Middle East Insider's April 22 calculation argues it cannot, the premium hardens into something semi-permanent. Which raises the question, who pays for it? The European household pays, at the pump, in the supermarket aisle, on the energy bill that arrives 60 days later. The Asian refinery pays, in shrunk margins and laid-off shifts. The European pension fund pays, in mark-to-market losses on paper hedges that no longer hedge anything. The German manufacturer pays, in furnaces that go dark. The shipping company pays, in reroutings around Africa that add 14 days to every Asian voyage. And the global poor, the ones with no buffer, pay first and worst. The World Bank report this morning warned that emerging market food import bills could rise by 22% in the second half of 2026. That's not an abstraction. That is roughly 73 million additional people, by bank estimate, sliding under the food security threshold. Now here is where it gets uncomfortable. Because if you are watching this from inside North America, the math is, frankly, in your favor. The Energy Policy Center at Columbia argued in February that restricting U.S. oil exports, the populist move, the America First reflex, would actually backfire badly. Domestic prices would barely move, and the U.S. would lose roughly $50 billion a year in trade surplus and refining margin. So the export valve stays open, the wall stays up, and the gap stays priced. But there is a catch. There is always a catch. The fortress works because the math works. The math works because the Permian keeps producing, Canadian heavy keeps flowing south, and the Gulf Coast keeps refining at 96%. Take any leg out and the floor cracks. The Oil Sands Magazine Outlook flagged it explicitly. The Permian's 6.4 million barrel a day plateau is forecast to hold through 2027, but only if drilling activity continues at current capex. If Brent retreats below 70, the Permian's marginal wells stop being drilled. If the US dollar surges another 8%, Canadian heavy gets repriced and pipeline economics shift. If a single hurricane hits the Gulf Coast in August, and the National Hurricane Center is already flagging an above-average season, the refining bottleneck moves from Singapore to Texas in 72 hours. There is something else, a number nobody is talking about. 6 million. Hold on to it. That is roughly the daily volume of crude products North America needs to keep exporting to maintain the divergence. If political pressure inside the US, populist anger about selling our oil to foreigners while gas hits $5, ever pushes Washington to throttle that valve, the wall stops being a wall. It becomes a temporary curtain, and curtains burn faster than concrete. So the bigger question, the one the Bloomberg desk and the Goldman Commodities team are quietly trading on right now, is not whether $200 Brent is coming. It is whether $5 WTI gas, when it arrives in November, becomes the thing that finally cracks the political consensus from the inside. Because the moment a U.S. senator from Ohio or Pennsylvania goes on Sunday television and says, "We built this fortress for the wrong people," the moment a working-class district decides that exporting refined product to Asia at world prices is a betrayal, the wall starts to come down. Not because the geology changed, not because OPEC negotiated, but because the politics of the inside cracked. The strangest thing about a fortress is that you only notice it from one side. From inside North America, the wall isn't visible at all. It just looks like normal life, like prices behaving the way prices have always behaved, like the world's chaos failing to reach the gas station 2 blocks away. From outside, it looks like a wall the size of a continent, and Klaus, Raj, and Hannah are standing in its shadow, doing the math on what their next quarter looks like. The barrel of oil that costs $87 in Cushing and $142 in Rotterdam is not 2 products. It is 1 product, on 2 sides of a decision. The decision was made over 12 years, in pieces, by geologists, refiners, pipeline operators, trade negotiators, 2 American presidents, and a handful of Saudi princes who didn't see it coming until the spare capacity number stopped covering the math. Most of the people who built the fortress will never use the word fortress. Most of the people protected by it will never know it exists. So the only honest question to leave you with isn't whether gas hits $5 a gallon. It will, briefly, somewhere in the second half of the year. The honest question is who inside the wall will be the first to stand up and say it isn't fair, because that is the moment the next chapter of this story starts. And we are going to be tracking exactly that, the first crack from the inside, every Tuesday in the newsletter linked below.